Well, good morning, ladies and gentlemen, and welcome to this morning's early session on financial scenarios, where we're going to try to tease out some clues about the future shape of the financial system. You don't need me to deliver a long introduction on the changes that we have seen in this crisis, and of course changes which are taking place really every day and every week. The World Economic Forum with Oliver Wyman have done some useful and interesting work, I think, on trying to sketch out some of the scenarios for the future in relation to the regulatory system and how future changes in regulation can affect the structure of the financial system, and that report is available for you. But given the individuality of our panel today, I'm sure we won't focus just on that. We have an outstanding cast this morning. It's wrong to say that they are the only 7 people left in their jobs in the financial system. That's not the reason that they're here. We have from the left Henry Kravis, KKR of course, Agius from Och-Ziff, Sheikh Hamad Sayari from Saudi Arabian Monetary Authority, Marcus Agius, the chairman of Barclays, Walter Kielholz, Suisse, Jean-Claude European Central Bank, and of course Tony Tan from the GIC in Singapore. So we have private equity, hedge funds, investment banks, and everything you can think of, and of course the referee principal in Europe, Jean-Claude Trichet. Now, to adopt a cricketing analogy so loved of foreigners, I am going to bowl them each a ball that they can hit to start with. And that, together with the fact that he comes first in the alphabet, suggests that I should begin with Marcus Agius, the chairman of Barclays. Marcus, we've seen, of course, in the UK 2 rescues. Gordon Brown has saved the world, in his own terminology, twice. Now we've got a position where at least one of our banks is 70% owned by the British government, another almost 50%, not, of course, Barclays. But people are beginning to say, well, isn't this just putting off the obvious conclusion, and that effectively the British banking system will be nationalised? Is that where we're going?
I don't think so. But before I answer the question, I just would comment that your turning to me first reminds me of being back at school, where when the punishments were delivered, they were usually delivered in alphabetical order. So I was always the first one to get it in the neck. But to your question, I think the place to start is that the government investments in the UK banks that have taken place were taken in extraordinary circumstances last October, and they were taken for reasons of expediency, not for policy. The money was invested because the money was needed to be invested in very short order. And that is the situation we're in at the moment. And of course, despite those investments in the banks that you've talked about, it's not just Barclays that's left outstanding. A large player in the UK is what I used to call Midland, now part of HSBC, and of course Santander and Abbey, Standard Chartered. There's plenty of other people who are not in that same position. I can't comment on what the government's future policy is. But to your question, I think everyone would have noticed the statement, or rather the article in the Financial Times, I think last Thursday, by Paul Miners, Lord Miners, where he said that the government's policy is to return the shares back into public ownership rather than to go in the other direction of further nationalisation. And indeed, since then, the package of measures that was announced last week, a good package of measures which we welcomed, provided more support for the banking system, but very clearly was not further nationalisation. And in the UK, Howard, I think our record of nationalisation is not great. We think companies are better managed by the management, and that fact, if you like, is realised by the way that the shares are held through an intermediate holding company, UKFI, which I gather unattractively is called UKFI. And that already provides a measure of distance and objectivity. As to how it's going to go in the future, I think in time these shares will be returned to the market, but for that to happen, two things we've got to happen. Obviously, there's got to be a return to stability, a return to profitability, but also we all, and I'm sure we're going to be talking about it later, need to see what the shape of the regulatory framework is going to be, and that's going to be very important.
Thank you, Marcus. Now, as you can see, the question of precisely what is the alphabetical order here is slightly tricky. But in fact, if Sheikh Al-Sayari will excuse me, I'm going to call you S, because I think that it feeds, what Marcus said, feeds into Walter Kielholz quite well, in the sense that Marcus ended by saying that the question of the structure of the banking system depended to some extent on the structure of regulation. Now, one issue which has come to the fore in the last few months has been that, from a taxpayer point of view, you can argue that the taxpayer has had to come in to bail out institutions. Why? Because the authorities believe that they are too big to fail, and particularly, of course, because they have retail depositors, and governments don't wish to let retail depositors lose out. But where have the losses occurred? The losses have occurred in wholesale markets in many cases. So banks appear to have been taking deposits from innocent retail depositors and putting them on a roulette wheel in the casino. Does that describe well the Credit Suisse business model? If so, do you think that in the future regulators, whether in Switzerland or elsewhere, are going to tolerate the universal banking model with retail deposit taking kept in the same institution as the riskier wholesale business?
Howard, as one positive side of this crisis, I was hopeful that the Swiss bashing by the UK representative of the financial market would stop for a moment, but apparently this is not the case. So, no, I think first I would like to stress that so far nobody has to come really to our rescue. But answering your question and joking aside, I think every banking institution, in particular in our case, has a history. And this history has a client franchise included. And in our case, it's probably a very special client franchise with a large international private banking client group, a relatively small home market, and an investment banking which is, for us, also an old tradition, an old history already. So I don't think financial institutions will move away quickly from established business models, whether they are called universal banking business model and so on. Don't forget that even only 6 or 7 months ago, everybody was convinced that the independent investment bank was a good business model, and then it happened that it was not the case. So I think what is in the future much more important is what is your base, where is your client base, what products do they need, and how do you manufacture them? And I think in this context, the combination of the three businesses, private banking as the largest business, Swiss retail business as a solid platform on which to stand, and an international, a global investment banking business is probably a unique combination which not every institution has in this context, but that's history. So going forward, I think from my point of view is what is the exact or the good risk profile that is appropriate for this kind of business model. And this question of risk profile in relation to the business model, that's the question which every institution has to ask himself. So when you are a regional bank in a continental European country and have client deposits and are in the lending to small and medium enterprises, and then have a risk which is entirely exposed to securities from the United States and I don't know what, that's probably not an appropriate risk model. So the discussion cannot be had universal bank no or yes, but each individual institution has to find its business model appropriate to its client franchise. That's my answer to that.
But would you expect, therefore, that the regulators will take much more interest in the walls and the subdivisions between your business activities in the future?
No, I think the regulator quite clearly will take an interest in that we can make a very strong case that our risk profile is appropriate to protect the individual depositor or individual private banking client. I think that is the priority. to give them assurance that the risk profile is okay. And that is what the regulator ultimately would like to have. To have legal walls and barriers in institutions, I don't think whether this is in a real crisis can be really upheld. I cannot see how we, for example, could have said, okay, we have losses in investment banking, and by the way, we don't really care because we care only for the Swiss retail client. That is not feasible. It's a little bit an illusion in my way.
And how will your business model be affected by leverage ratios?
Yeah, of course, I think to the risk profile, and in the context of the distrust of statistical risk-based models, which have proven that they are in severe crisis, apparently not giving expected results, let's put it this way. In the context of that, we go back to a much more simple view that there is just a limit to leverage which you should have. In our case, of course, which is not a huge lender in a huge economy, the limitation, the restrictions which we have to apply given on a leverage ratio, the limitations which we have to apply to our retail and small and medium enterprise client base is not severe, not at all. But if you are a huge lender, then it becomes more a problem.
Thank you. Henry Kravis, the private equity industry, of course, has not been spared its excitements over the last year or two with reduction in the availability of leverage to the business. And of course, the competitive landscape within which you operate has changed. The investment banks have become bank holding companies, which alters their profile to some extent. Of course, also, we've had essentially the closure of the public equity market. So if there is equity to be had, it's from people like you or from Tony Tan. But looking forward, how do you see the private equity business model in the future? Is the old model fundamentally broken? Do you have to redefine your role? How does the future look to you?
Well, first, Howard, thank you, because that's the nicest way that I've ever heard anybody ask about private equity. It usually is private equity is dead, and then we start from that.
I took that as read
for that. Private equity is not dead. Look, like every industry, we are suffering as well. There's no question about it. I think the way I would look at it is we have to ask ourselves a number of questions, and I sort of break that down into possibly 4 questions. And one is, does our basic leveraged model work in a deleveraging economy? 2, I would say, can we raise capital and do deals in an environment like this? 3, can we continue to effectively manage the companies where we have made investments? And last, can we earn the trust and support of the public, the shareholders, and the government? And I think you really have to look at all of those to say where we are. Number 1, yes, we can do deals in a deleveraging economy, an environment like this. We look back, I've been in this business for 40 years, started it back in the 1960s. And if you think through history for a minute, there have been a lot of different times when there was no capital or very little capital available for what is now known as private equity. And I think back particularly to 1979, when you had a 21 in the United States, which was the only place that private equity was going on at that time, and you had a 21% prime rate. You had inflation running at about 13%, high unemployment, and Paul Volcker was the chairman of the Federal Reserve at that time. And he came out, unfortunately, 2 days after we had announced that we were going to buy a company called Foremost McKesson and take it private, and he put on credit controls. What credit controls meant at that time is no non-purpose lending. Well, that was tough. And I compare that to today. You go through the period 1990-91, when practically 3,000 financial institutions in the United States either went bankrupt or were taken over by the resolution trust that was set up in a good bank, bad bank approach. And again, no money available. And we're in that period today. But interestingly, there is money because it's coming from different sources. What I think is going to happen is you look at can KKR and others like us who are doing larger transactions put money to work. Well, number one, 2008 for us actually was our third best year as far as putting money out, equity money out that we'd had. 2006, 2007 were phenomenal years because there was cheap capital, plentiful, and we put a lot of money to work. We put it out in 2008 also, but differently. It wasn't so much buying companies. Yes, we bought 2 companies during that period of time, but we made some minority investments where companies needed capital. They had an over-leveraged balance sheet. They had a need for capital because they had a capital project that they just needed to get done. They may have been in the middle of it, and their funding source was taken away from them. And so there are ways to put money to work. And that's not just going into the stock market and buying stocks. That's not what we do. We actually put direct investment into the companies themselves and work. Now, if you think about what's going to happen in the next 3 to 5 years with the amount of debt that is coming due, in the next 3 years alone, you have, just in the United States alone, and now this is magnified around the world, obviously, but you have $1.7 trillion of debt coming due, of which $1.5 trillion approximately is investment-grade debt, $200 billion is non-investment grade debt that is coming due in the next 3 years. Now, if you carry that out to 5 years, you have $3 trillion of debt. Now, unless the markets open up, there's going to be a real need for capital from somewhere. And that's where private equity can play a role. There's about $400 billion today of equity commitments to private equity. People like Tony Tan's organization and others around the world have provided us with long-term capital that can be used in situations like this. And if the equity markets don't open in a big way or the debt markets don't open in a big way, then obviously a need for capital like ours is very important. Now, the question is, can we raise capital in a period like this? Really referring to 2 types of capital. One is equity capital, and as I said, there's already $400 billion of equity capital available in the system. These are commitments made to people like KKR and others, and it's a long-term commitment to provide this capital. But what I'm referring to more is can we secure long-term debt financing? And the answer to that is yes. It's smaller, and it comes from different sources. So rather than just relying on the banks, who were basically acting as a conduit, they would make a commitment, they would use their balance sheet to make the commitment, we'd close the transaction, but even before we closed the transaction, in all likelihood, that debt was already laid off and sold anywhere to CDOs, CLOs, to hedge funds, to pension funds, to endowments, insurance companies, etc. And so they really were not taking any risk until the flow of money to them shut down. And so all of a sudden they had made these commitments, they couldn't lay it off, the music had stopped, and then they were stuck with approximately $300 billion of debt on their balance sheets when the music stopped, which they then had to start marking to market. They then had to start figuring out ways to lay it off, and they did at losses to each of the financial institutions. So what will happen going forward is different sources of funding will come to us. There are a number of sovereign wealth funds and some state pension funds, some corporate pension funds, insurance companies that are now making direct investments in debt. And basically what they're saying is, we won't go through the bank. You come talk to us. We'll work with you directly and provide the capital to you going forward. Firms like our own have set up our own broker-dealer operation so that we can go directly to any number of people to provide capital. It could be to people like Templeton and Fidelity and Wellington and other very large mutual funds that are providing capital, insurance companies that will provide capital to us, pension funds where we will go directly to them. So there are ways to do that. On the other side of buying companies, leverage obviously has come down tremendously. So rather than buying a company where you may get 7, 8, 9 times, and in some cases some deals were done, I gather, at 11 and 12 times debt to EBITDA, which is earnings before interest, taxes, and depreciation. What now happens is you may be able to buy a company, obviously a much lower purchase price, with significantly less leverage in it. And you can still get the same kind of returns that we could get in a highly leveraged situation or more leveraged situation because of the purchase price that you're paying and because of the fact that you're going to continue to run the company in a better fashion. Now that leads me to my last point, to my third point, which is, how do we run our companies? Well, in KKR's case, our whole focus is 100% on operational improvement. I like to say, don't congratulate us when we buy a company. Congratulate us when we sell it, because any fool can buy a company. Just pay enough. That's an easy thing. That's not the hard part. The hard part is, what do you do with the business to create value and grow that business, put money back into the business for research and development, for the proper capital expenditures, what have you. And so we're no different than probably many of you in this room that are running businesses. Our whole focus is, how do we improve the business? We take a long-term approach to investing. It may surprise you, but at KKR, our average holding period for companies is 7 years, on average for the last 32 years. We have many companies we've held longer than that. And I think what will happen in the environment we're into, because of the lack of an equity market to be able to exit, a lack of buyers, and if that continues for a while, I think in general holding periods will go up, and you will have to hold the companies longer, which means you have to focus on the companies. We do, and internally at KKR we have an in-house consulting firm which we've had since the early 80s. And today it's about 50 operating consultants. And one of the first things that we do when we buy a company is go in and put a 100-day plan together. Just like a 100-day plan that GE might put together when it buys a company. Very detailed, person by person, product by product, geography, etc. How do you shorten the supply chain? How do you improve waste in the product? How do you improve productivity throughout the organization? How do you improve the sales force productivity, and so on? These are the kinds of things that we do as a private equity firm, and that will not change. In fact, if anything, there is much more of a focus today on operational improvement in a company that if we're going to survive. Now, we had a meeting yesterday of the Investor Governors group, and Dan Ock and I and others were at this meeting. And one of the things that we talked about is, what are the issues facing the private equity world right now? And what's facing the private equity world right now is portfolio. You have to focus on your portfolio. And second is regulation. Regulation is coming. It's going to come in a very major way, in our view. Whether we'll be pulled into it as they regulate the financial institutions, we'll get some regulation, no question about it. Will it go too far? Remains to be seen. But there's no doubt in my mind financial institution regulation is coming. Typically, it will swing too far one way, and then it'll start working its way back over time. So with that, Howard, I think
Thank you.
Stop.
Thank you. Well, a modestly optimistic picture. You seem to have broken the Davos '09 rule, which is to be, you've always got to be more gloomy than the last person who spoke, as far as I can see. Well, the organisers, without consultation with me, put the terrible twins of private equity and hedge funds on the far right wing of the platform, perhaps appropriately. So I'm going to move to Dan. Och, well, hedge funds, where do we start? Unprecedented numbers of deaths of hedge funds, withdrawals, of course, the prospect of regulation, calls certainly by European governments that you should be brought into the regulatory net and your leverage cut back. And all the time, the hunt for alpha has become a sort of hunting the snark. It's not so easy to find it these days. Dan, cheer us up.
Well, that was optimistic. You know, when people ask about the hedge fund industry, there are really two ways to answer the question. I'll answer both. There's something that we've never really thought existed called the hedge fund industry, which is 8,000 or 10,000 participants globally. The barrier to entry is to raise your hand and say, I'm a hedge fund. And I'll leave it to George Soros and others, much more capable than me, to predict what percentage of them will not be in the business going forward. I am actually quite optimistic on what we call the institutional alternative asset management area. Funds that prior to the crisis had a focus on risk management, on systems and financial controls, on building real businesses, on developing deep long-term relationships with institutional clients, on providing transparency, having a focus on compliance, and other areas. Prior to the crisis in the institutional market, there was already a significant differentiation occurring between the institutional alternative asset management firms and all the other participants in the hedge fund arena. With the advent of the financial crisis, that differentiation has accelerated dramatically. There's been substantial investor disappointment in a number of areas. There was disappointment with the performance of many funds. There was disappointment when investors realized that many funds had only been generating return using leverage or using concentrated directional bets, and they didn't like the other side of that, which we've seen in the last 18 months. And there was, of course, disappointment when certain funds suspended or froze liquidity or in other ways suspended redemptions. There is a contraction going on in the industry right now. People have different numbers, but the total amount of capital in the industry that had grown dramatically is shrinking. Some part of that was from performance. Some part is from investor withdrawals as they need liquidity because of what's going on around the rest of the world. Having said that, prior to the crisis, if you look, the largest 20 firms, even as the industry grew dramatically and the number of participants grew dramatically, the percentage of total capital, not just the absolute dollar number, but the percentage of total capital in hedge funds that was allocated to the largest 20 firms grew each year prior to the crisis. We are very confident that going forward, that consolidation / contraction, because it's both, but that consolidation is going to be dramatic. And those who have performed and have delivered will I want to say flourish going forward, because we've got some hard times to get through in terms of the economy and the markets, but we'll do extremely well going forward.
Thank you. Sheikh Hamad al-Sayari, you've had an exciting couple of years as well. Of course, sitting in Saudi Arabia, seeing the oil price go to 147 or whatever, and then back down to 30 or wherever we are at the moment. Of course, also, Saudi has been brought into decision-making in the financial system to a greater extent than before. The G20 has now been chosen as a vehicle for the summits. Give us a perspective from Saudi Arabia on, one, your relationship with the world economy, particularly in relation to what's happened to this huge swing on the oil price and how that's going to affect financial markets, but also a little bit about how you see your growing role in international financial decision-making.
Well, thank you. To start with, in an atmosphere of gloom and doom, people have written of 2009 without a growth, and I will not exclude myself from that group. But I want to mention a factor that is significant working out in the global economy, but it is overlooked, not mentioned, and that is, even though the IMF has been calling for a stimulus package of 2% of GDP, the drop in oil price between the average for June, July, and the average for December, January is equivalent of 5% of global GDP of a tax-like cut. And this is very significant stimulus, but it is not mentioned, not appreciated, but it is direct. It is direct to the consumers. The American consumers, for example, are saving every day about $1.2 billion just from the drop in gasoline and diesel price between July and this time, about $2.4 a gallon. And that is significant. And hopefully it would help stimulate the economy. Maybe it would, it is not going to be the solution, but it is probably offsetting some of the negative factors. So this is an observation that I want to share with the audience, which is, I think, important. On the G20, as you know, with the shift in the weight globally over the years, the old grouping are not relevant anymore because they don't include the new economies which are systemically important. So the G20 is brought up, and it includes between 70 to 85% of the global economy and global population, and includes all the systemically important economies. The group has been meeting for several years. They have agendas. They address the issues that are of importance to the global economy. And at the current time, they are even more important than at the time when it was created. I am sure all of us, especially new members, would work cooperatively to address the issues that are important for the global economic growth and development. I see it from the interest of all members, and I think it is important development in dealing with the global economic issues.
Thank you very much. Before I move to Tony Tan, I should just say that at the end of our first round of questions, I shall then be throwing it open to the audience so you can start to think about the points you want to put. Moving to sovereign wealth funds, this has also been an interesting story over the last couple of years. For a long period of time, funds like the Singaporean funds or the Norwegian or Kuwait managed themselves quietly, were often long-term patient shareholders, and nobody raised any great concerns about them. Then, of course, we suddenly went through a phase where people got very anxious about sovereign wealth funds and what were they up to? Was this political investment, particularly some deals in the US people became nervous about. The arrival, of course, of new sovereign wealth funds from China on the scene generated anxieties as well. And in the middle of that, there were governments saying there must be some kind of code of practice, and the IMF was put into play to try to work that out. Then, of course, we went into a period where, far from being the pariahs of the financial scene, they were the cavalry coming over the hill with capital to rescue ailing institutions in New York and in London. And this has been, I think, a rather confusing time, particularly for a sovereign wealth fund like the GIC, which has been a part of the landscape for a long time and not really causing any trouble. Tony Tan, how do you see the picture now? What difference will the Santiago principles devised from this IMF exercise make to sovereign wealth funds? And looking forward, how do you see sovereign wealth funds fitting into the new jigsaw of the financial sector that is starting to be put in place?
Well, let me first say that the role which sovereign wealth funds will play in this new environment cannot be seen in isolation. It has to be seen in the context of the enormous political and economic difficulties which are faced by countries everywhere today, and there's no doubt that there's been huge economic and financial damage done to many countries with high unemployment. Therefore, it's reasonable that governments should take immediate steps to try and implement radical stimulus plans. $825 billion by the US, a huge package from China and other governments in order to try and stave off what they see as a potentially disastrous economic collapse and a protracted global stagnation. This has to go on, this has to be done, but the world economy will not go back to sustained growth until the world's economic, the world's financial and banking system has stabilized. So there has to be, in my view, a radical overhaul of the present global financial system and the infrastructure which regulates it. Now, it's with government central banks being focused on the immediate economic problems, the process of reforming the global financial system is still in a very initial and fluid state. But it is going on. It will almost certainly be led by the US in its efforts, which will set a pace for reforms in this sector. Other partners, particularly Europe, Japan, other governments in Asia, will have to participate in this restructuring. There will be some new emphasis, I believe, in this new regulatory structure. One is financial stability will become very much to the forefront, including the role of central banks, which traditionally have focused on two main targets. One is to maintain price stability, and the other is to promote economic growth. But the need to ensure financial stability, I think that will become a very important task of central banks. In this context, sovereign wealth funds like the GIC can play a helpful role because they have the ability to provide capital in this post-crisis financial system, and also by offering their views as people on the buy side in how the new markets should develop. So it will be helpful for sovereign wealth funds to take part in this dialogue. There are two particular issues, perhaps, which is worth mentioning in this context. One is the likely shape of the banking system going forward. This is not set in stone. It will change, but the way things are going now is likely to be seen that the banking world will be divided into two types. One is a core of possibly very large commercial banks, which will dominate the traditional banking roles, which will be tightly regulated, probably working with much lower leverage ratios than in the past, and essentially guaranteed by governments. and a periphery of other institutions, private equity, hedge funds, which will be less tightly regulated and possibly be smaller than in the past. I'm not sure where the investment banks will be, but possibly somewhere in between. A major issue, in my view, will be how to resolve the present ad hoc measures taken by governments to stabilize their banks. In the climate of what happened in 2008, it was necessary for governments to directly intervene in the banking market by taking shares in banks, which has been done in the US, in the UK, Switzerland, and other countries. This was necessary to create confidence back in the banking market. The problem now is that with governments heavily involved in running banks, how will this be resolved? At some stage, it must be that governments will want to get out of the banking business, restore the banks back, bring in private sector shareholders. Otherwise, the world will be run by a few government-controlled banks. I do not think that this will be good for the world's economic system. How this is to be done depends on how governments want to denationalize banks on the terms in which they extract their equity, on the terms in which they allow the banks, they allow private sector players to participate in buying shares in banks. If governments wipe out the equity or the debt of private shareholders, then I think that no private shareholder will ever invest in banks anymore. There is no incentive. There are, I think, some risks going forward in this exercise. One is this has to be an international effort, but whether the various government central banks can coordinate effectively, I think remains to be seen. If coordination is not done well, there is a risk of financial protectionism or fragmentism occurring, as spelled out in the recent WEF report. And finally, I think the danger is that the pendulum may swing from one extreme, which was a regime of deregulation, perhaps insufficient supervision, to over-regulation, which will inhibit financial innovation and I think retard the growth of healthy products. By and large, despite all the excesses of the last 10 years and the difficulties which we are in, the financial products which have been made available have allowed more people and more companies to access the banking market, has generally provided economic growth. We should not allow what has happened in the last 2 years to color our efforts and our direction in the coming years. I think that if that were to happen, we will compound the difficulties which we are facing now and possibly face the prospect for a prolonged recession, which is not in anybody's interest. Thank you.
Thank you. Can I just pick up on one of those points, because it comes back to what Marcus Agius said right at the start. You talked about the need for governments eventually to exit from ownership of their banking system. Well, in the UK, the government have set up the UKFI as a sort of holding company. I think perhaps they've copied it from Central Huajin in China, maybe. Does that seem to you to be a sensible structure? Is that something which other countries could copy?
I think each country will have to decide on how it should proceed ahead. What is important is not so much the structure of how this is done, but the principles on how this denationalization of banks will take place. And I think that it is extremely important that when governments exit from banks, or they do it on terms which gives the private sector an incentive to see that although banks may be less profitable going ahead, they will still be profitable, they will be reasonable investments, and there will still be an incentive for private shareholders to continue to take part in buying bank shares, and in that case, return the bank back to the private sector so that there will be a diversity of banks, which I think will be helpful for the world economy.
Thank you. Well, I think that's everybody. Oh, sorry. Actually, I ought to tell you there's a reason for this. As many of you know, yesterday was Jeudi Noir in France, and Jean-Claude told me earlier that as an act of solidarité with the grévistes, he was not going to answer any questions today. Actually, though, Jeudi Noir was perhaps for Jean-Claude followed by a Nuit Blanche, and now we have Vendredi Bleu. I think perhaps I might tempt you to answer a question or two. Clearly, the crisis has demonstrated fundamental problems in the resilience of the financial system. At the moment, of course, there are two tracks, I would say, which people are following. One is what you might call the firefighting track, and clearly the ECB is still engaged in that, the provision of liquidity and governments pumping money into the system one way or another. But I think this morning we're trying to look a little bit beyond that. And the longer-term agenda is clearly about the international financial architecture. What new decision-making structures do we need to put in place to try to produce a better system of rules and regulations in the future? Also, of course, people say we need to bring in more countries. We've already talked a little bit about that, the use of the G20. And, importantly, to try to establish a stronger link between macroeconomic policies and financial stability policies and the details of regulation. Jean-Claude, how does all this complex of issues look to you? What kinds of changes should we be thinking of making as we look forward to the next G20 summit in London in April?
Well, first of all, I would say that you're absolutely right in mentioning the fact that it is not only necessary for central banks and governments, and by the way, they were, I'm not speaking for central banks, but for governments, they were also very prompt in coping with exceptional situations, and this is an element which we should not forget. But that being said, what counts, of course, if we want to re-establish confidence, is to have a long-term vision and to clearly see how we can make, as convincingly as possible, and I would say taking into account the urgency of the situation, also as rapidly as possible, I would say global finance and a global economy which would be much more resilient. As you said, Howard, the demonstration we have is that we have a fantastic global economy and global finance which has produced a lot of wealth over the last years, and this is really absolutely remarkable. But it has elements that are embedded in the system, which are augmenting the booms and the busts, which are amplifying the normal fluctuations of a market economy, and all this has to be corrected. We need absolutely to have a global economy which would be more resilient. The avenues, it seems to me, have quite well be prepared, and the Financial Stability Forum in particular has worked a lot. The G20, which is, as said Governor Sayari, representing a very large part, an overwhelming majority of the global GDP, is and will be decisive as an informal body in permitting to mature the consensus which is necessary. But if I had to sum up the main avenues I see, and I'm only summing up what has been prepared already, I would say much more transparency. This was said by a number of speakers, but it's true for the financial instruments, it's true for the markets, it's true for the financial institutions, and we need big progress in this domain, even if vested interest might still have an interest in being obscure. But it is absolutely out of question that we could be back, I would say, to the previous state of the situation. Now, we have also to correct systematically, as much as we can, all the procyclicality which is embedded in the system. Certainly in the financial rules and regulations that we have in the prudentials, in the accounting rules, in the behavior of the private and public authorities and private institutions. Again, there a large number of avenues have been identified. I think it's absolutely key. And part of this fight against procyclicality is certainly the fight against short-termism, much excessive short-termism. I was interested by Henry mentioning the fact that one of the consequences of the present situation was that he was pushed and the industry was pushed to be much more long-term. And I think it's absolutely necessary. But all that being said, this is the financial sphere. You mentioned yourself the macro policies award, and I really trust also that if we are improving very significantly the financial sphere, the financial system itself, but if we forget that macro policies have also to be sound and reasonable and convincingly reasonable in the medium and long term, then we will recreate the recipe for problems. So I think as a complement of all what we do on the financial sphere, it's very, very important that we have surveillance of the macro policies. And of course, in this respect, both, I would say, the IMF and the peer surveillance are absolutely necessary. And in my opinion, are part of precisely these avenues that we are engaging in. And I hope we will be able to crystallize quite rapidly, obviously. But a lot of hard work is being done, and speaking under the control of Governor Sayari and of yourself, sir, I think that the central bank, as you said, have an important role to play, because we are there to have a long-term, medium, long-term vision ourselves. And I think that this is of the essence now.
How would you characterize in the future the respective roles of the Financial Stability Forum and the IMF? Because there has been some debate about how the two should interact with each other.
I think the IMF is a global institution which has authority in a large number of domains, including this peer surveillance, which seems to me absolutely essential and can help and is helping a lot of countries right now. The Financial Stability Forum is an entity which is indispensable because it permits to merge consensus on a very, very wide array of authorities and responsibilities, if I may, because you have here interacting the governments, the central banks, the IFIs, the international financial institutions, and also all those, I would say, decentralized, independent institutions that are responsible for prudentials, both prudentials in the insurance business and in the banking business. They have the responsibility, of course. The SECs of the world are there. And you know that they are very much independent themselves. So it's very, very important that you have a place which is informal. It's not an institution. It's an informal place where you can really compare notes and be sure that you don't lose sight of the system itself when you all have your own responsibilities. So I really trust that we find out a nice way to cooperate. But again, the franchise are not at all the same. And the IMF is key, in my opinion, for the two reasons I mentioned.
I'm going to come to the audience in just 1 second, so just one more question from me, Jean-Claude, on Europe, where I understand you have some responsibilities. The crisis has also demonstrated some problems in the European single financial market, where some of the ways in which banks operate across Europe have demonstrated some flaws, and not just in the European Union, but in fact the European Economic Area, I guess, is the most relevant thing, where if you're authorised in one country, you can operate in another on a branch basis. Of course, the case of Iceland, that turned out to be somewhat problematic. In the UK, there have been other examples. The Fortis example shows the complication of dealing with a bank with large operations in different countries. What kinds of reform do you think we need in financial governance in the EU in the light of these difficulties?
First of all, I would say that you're absolutely right to mention Europe as one of the issues at stake. I would say also that the very same issues that you mentioned, Howard, is true at a global level. We have for all, I would say, cross-border institutions, this issue. It's much more important, of course, in Europe because we have a single market. We have a single market of financial services, and it goes, as you said, also over and above the European Union stricto sensu. I would say that as far as my institution is concerned, first of all, we were always very much in favor of a close relationship between the central banks and the banking surveillance authority. And Governor Sayari knows that. We've been always very, very clear of that. It seems to me that what we have observed over the last years has demonstrated that that close link was indeed something which was important. As regards we always encourage ourselves intimate cooperation between all banking surveillance authorities in the euro area, in the European Union as a whole. And you're absolutely right again to mention the fact that it's even bigger than the European Union. We continue to exert maximum pressure, if I may, amicable pressure, for this cooperation to be as intimate as possible. A lot of progress has been made with the MOUs that have been signed by all authorities concerned. I think the College of Supervisors are a very, very important concept which we have to push as much as possible. As regards my own institutions, as you know, Howard, we at this stage have no position of the Governing Council, so I cannot tell you what is the position of the Governing Council of the ECB. We have noted that in the Treaty of Maastricht there was the mention that Article 105.6 would permit the governments to give us more responsibility in this domain. We will see how it proceeds. And I have also to mention, as you know better than anybody, that we have also the Banking Supervision Committee, the BSC, which exists in our own framework, and might appear to be also a very useful body in the present circumstances. So we will see it's work in progress. A lot of ideas are examined by the Parliament, by the Larosière Committee, and we will see what they propose.
Thank you. Well, now it's your turn to contribute, and I'm happy that people should make comments or ask questions. I warn you, however, that the one type of question that I really don't like are the ones where you say, I want to ask each member of the panel what they think the dollar exchange rate with the euro is going to be in 3 months' time, or something like that, because that's kind of 7 questions in one, which I think breaches some kind of code of conduct. But who would like to kick off? Yes, on the front, and if you could give your name and where you're from, that'd be helpful.
Yes. Hugo Dixon from BreakingViews.com. I'd like to ask the panel, but particularly Jean-Claude Trichet and Governor Sayari, about whether we need a new tool in central banks to manage the excess build-up of credit in boom times. I mean, one of the things that people are increasingly talking about is how the interest rate is not an adequate tool. It's only one tool in the toolbox, and as well as having an interest rate, that what central banks should do when they see an excess growth of credit in the economy is that they should push up minimum capital ratios, so that, for example, maybe you have, say, I mean, if you take 4% as the minimum capital ratio, maybe in a boom time you should be saying, well, actually it should be 10%, and in a bust time like the current, maybe it should be going down to 4 or even below 4. And I'd be interested to know whether you think that this is going to be a good idea for us to try to implement in the new financial architecture.
Thank you. Governor Sayari, do you need a new tool? A macroprudential mechanism in the jargon?
Yes, I think, well, it is obviously a very important and timely question. I'm sure all monetary authorities are conscious and thoughtful of the potential risk of the excess liquidity. I can say with certainty that all central banks have the tools to deal with excess liquidity, and this is have been proven in the past. Now, it becomes an issue as to the timing, and it is always making decisions on prospects, on futures. But yes, there are the tools available at the central banks. And there is the cautiousness and even discussion of what, when in the future. I think I can say this. I would leave it to President Trichet if he wants to add.
Well, I would say that, of course, it depends on the responsibility of the central bank in question, and Governor Al-Sayari has the responsibility not only of monetary policy but also of banking surveillance. So in that case, of course, you can have a play on the two, I would say, instruments. As far as most of the central banks in the world, they would consider that their franchise is to provide for price stability, and the instruments they have, as you mentioned, are the interest rates. They consider that an appropriate understanding of their mandate is certainly that price stability in the medium and long run is a precondition for financial stability. It doesn't suffice, but it's a precondition for financial stability. So they all have the sentiment that they are working for financial stability, provided, of course, they have this long-term understanding of their mandate, which is in practically, I would say, all legislation or charts. That being said, your question is very important because it is implicitly the question of how to be anti-cyclical, or at least not being pro-cyclical in the prudential area. And I have to say that this is a very, very important theoretical question and practical question today, because the market has a tendency to be spontaneously pro-cyclical, enormously pro-cyclical. And as regards capital requirement, as a matter of fact, we say we have capital requirements, but the market is demanding more than the capital requirement we consider appropriate. And so the capacity for us to be, for the future, much more anti-cyclical, or at least not pro-cyclical, is certainly something which is extremely important. And this is independent from monetary policy. But monetary policy, good monetary policy, in my opinion, are per se, and when reasoning medium-long-term, price stability medium-long-term are a precondition for financial stability. But again, the prudentials have their role to play and must play their role. Walter?
I just would like to come in on this question. It's very tempting and theoretical, of course, great, anti-cyclicality. But both ways, I don't believe in it. If you are in an upswing, now let's assume we get through this crisis and we have an upswing, and then all of a sudden you do this. Even if central banks increase interest rates at that point in time, the outcry political to actually take the air out of the upswing and to actually destroy the prosperity are huge. The other way around, I tell you, this is also very tempting. But exactly in a moment when the whole market is looking for more confidence, more trust, the regulator says now we lower the capital levels in the system. And I would like to see the headlines in breaking news to say reckless reduction of trust in the system. And as Jean-Claude says rightly, the market is doing exactly the opposite. The rating agencies becoming much more severe because they have been criticized, so nothing should actually get damaged anymore. The market says, well, we thought 6% Tier 1 ratio was good, now we ask for 12. And you can declare that 6 is enough, nobody believes it. The market just think that the authorities are now recklessly destroying what is left for trust in the system. I don't believe in this.
Thank you. Yes, Gillian Tett over there in front row.
In terms of thinking about where the financial system is heading. I'd be interested to ask Jean-Claude Trichet's views, and anyone else who'd like to comment, on where you'd put credit derivatives within that framework. And in particular, do you think that credit derivatives need to sit on a regulated exchange? Do they need to be part of the central clearing platform? Would the ECB like to oversee a central clearing platform for credit derivatives? How do you see those types of financial innovations developing?
Well, I would say that I think it's very important on both sides of the Atlantic that we have, as I said, much more appropriate functioning of the derivatives market in general. The initiatives that have been taken to introduce this central counterparty seems to us very, very wise, and we will certainly push them. I have no, I would say, definitive response on the best oversight that we might have. We exclude absolutely nothing. But what is important is that we make big progress in this domain, and I think that there is a will to be, and all the authorities I know are pushing in the direction of active implementation of this much better organization of the derivatives market in general. This is one of the areas where we could see an explosion and of national outstanding, and where probably we would have been well advised to look at it earlier.
Dan, can I ask you to comment on that? Do you think it makes sense to bring these credit derivatives onto some kind of exchange, if you like, or in a central counterparty system?
I'd echo Mr. Trichet's comments. While we don't necessarily have one specific methodology that we endorse, we think the concept of having it more controlled, having more transparency, we have been big proponents of that. We continue to be believers and supporters of those methodologies.
Thanks. There was somebody else just here, in front row.
Thank you. Joe Casputis from Global Insight. In thinking about scenarios for the future of the financial situation, it seems to me obviously we have to address some of the problems we've just seen. One of those, of course, being the management and control of risks, and I think another is transparency and accounting standards. It seems like we've had an economic collapse, and then we had a financial collapse, and now the financial collapse is bringing down the real economy further. And I'm just wondering, particularly the commercial bankers on the panel, do you think that the mark-to-market rule needs to be addressed? Clearly, with the rapid drop in the economy, there are lots more bad loans on bank balance sheets. On the other hand, one has to believe that many of the loans that had to be marked to market, which is essentially all of them, if held to maturity, a number of those would be repaid. It seemed like we let the air out of a tire all of a sudden with mark to market. And I'm just wondering if anybody in the panel thinks that that needs to be addressed.
I'm sure that Marcus has a view.
And that is that I think it's sort of to what Jean-Claude Trichet was talking about under the general heading of pro-cyclicality. Any system which exacerbates and makes things worse is not desirable and not helpful. And we've seen the effects of that in the recent times and the way people have been trying to address that. Measures were taken, and I think more measures need to be taken. And there are times when one needs to recognise that one is in exceptional territory. I mean, the basic fundamental thinking behind mark-to-market is absolutely valid and sensible. People need to know on a day-to-day basis what the assets are worth. But if the process of measuring actually increases or decreases the value of the asset, that's not in anyone's interest.
Henry, do you have a view on this?
I do. Look, mark-to-market, in my view, plays a very important role. I think where it's gone wrong is the question of how do you measure illiquidity, and as opposed to actually measuring the risk. And I think the definition is wrong. And my guess is that when the new regulations are finally written, on a global basis, that they will take some of that into account. A large part of why the banks and other financial institutions had to write down the assets as much as they did was really more because I can't sell it today. Doesn't mean there's an impairment in the quality of that asset.
Thanks. Walter?
Can I make a point which is more fundamental in this context? When I went to university, I learned that banks and insurance companies were financial intermediaries and had a transforming task. So banks made short deposits, which they get into longer-term, medium-term loans to the industry. Insurance companies were collecting savings and making long-term loans to the economy. Now, with the mark-to-market, what I would say, enthusiasm, we, in a way, started to destroy this intermediation capability, to take a long-term view and to take at this transformational task. I do not see who then, if the life insurance industry and other large collectors of savings are no longer in a position to make long-term loans and actually take a view in the long term to the economy, who is going to replace them? So my question is much less about mark-to-market or not, but that we have the right asset classes properly classified in the accounting system. Of course, the temptation, and there we take the blame, of course, the temptation to front-load revenues and earnings through mark-to-market, you know exactly, was a huge temptation in the last 10 years. And now we also all of a sudden front-load the losses in mark-to-market because it's not sure whether the losses ultimately actually happen. And so it puts an enormous stress on capital calculations in the meantime. So it's more a question, have you really classified all asset classes and liability classes in the case of insurance companies in the right valuation sector? And maybe there is more work to do than just talk fundamentally about mark-to-market or not.
Thank you. Yes, a woman right at the, well, not quite at the back, yeah.
Sherry Nusalim from GT Group. We hosted Dean J. Light from Harvard Business School at 3 Talk in 3 on the Bun, and we asked the question whether the business schools should take some responsibilities for some of the results of the financial system, given that they produce a lot of the captains in these banks and markets. But he said there's only a few years, a short-term warranty. So, but I think what is significant about what he said was that the incentive system, in his view, actually played a significant role to the outcomes. And my question is, I know in Singapore, I think incentives not just in terms of the private sector, but at the regulatory and other aspects. In Singapore, there's a sort of good systems for the civil servants, and I'm just wondering, in terms of, I think in Alvin Tochter's book, Revolutionary Wealth, he talked about the mismatch of the regulatory systems and, the private sector system. There's a different speed of development. And I think I applaud, for example, Singapore government, where they really spend a lot of efforts in building the talents and properly incentivizing the government sector. So I would like to sort of learn about your thinking about the incentive system overall across the different sectors. Thank you.
Well, I think I have to ask Tony for a quick comment on that. Are you properly incentivized, Tony? Is that?
I think one thing which the Singapore government does differently from a lot of other governments is that we pay our politicians and our government servants very well. We mark their remuneration to the market. And that's a deliberate policy because we believe that you must have as good people working in the government, in the regulatory authorities, as those who are working in the private sector. Obviously, of course, the remuneration, while some people may regard it as very generous, is still far below what I suppose Wall Street investment bankers were getting 1 or 2 years ago when business was very good. But I think this is a very fundamental point, because no matter how good the regulatory structure may be, no matter how effective in theory the system may become, it still has to be implemented, it still has to be supervised. And I think one of the things which I worry a lot is that given the disparity of rewards between the public sector and the private sector in America and in Europe, there is always a draw for able people to move from the public sector to the private sector. Of course, there are exceptions when you get men like at the highest levels, like Ms. Paulson and other people who would move into the public sector. And in England recently, you have Paul Miners as Mervyn Davey moving from the private sector to take up responsible positions in government. But these are very rare. What you need is to have a systemic process of making sure the public servants are not underpaid. I think the difficulty for many governments is that because of political pressures, this is very difficult. And I worry a lot about this, because you do need, particularly in these very difficult times, capable people in the central banks, in government, in the treasury, who can effectively supervise the banking system, the commercial banks, companies, and they have to be as good as those in the companies and banks which they supervise. So I'm not sure whether I've answered your question, but that would be my reaction.
Thank you. Marcus, do you think that in London we should pay regulators more and bankers less?
I think we should pay all people a fair reward for what they do. And I won't talk about regulators, but I'll talk about bankers. And if you focus on the use of the word incentive, it's the right word. Properly designed, an incentive is meant to be a spur to generate the creation of wealth by an individual. If they behave in a certain way and they create wealth, they will be rewarded. That's what the incentive is designed to do. Now, it may well be, and indeed has been, that in the past there have been systems designed which have worked imperfectly. You know, the wealth that has been created has not properly been calibrated because the perspective has been too short or whatever. But I think it's also fair to say that while a number of people clearly do create wealth by use of their brain power and by use of the company's balance sheet and other resources, other people have been receiving incentives basically for turning up, and that I don't think is very smart. But the idea of an incentive system properly designed and fairly calibrated, I think, is absolutely fundamental.
In the States, the disparities are greater than anywhere else, in the sense that the public sector is paid much less, and of course in the private sector much more. Do you think that is a part of the American regulatory problem, Henry?
No, I don't think that's it. Look, the government has gotten some very good people in America to go into the government and to work and do a very good job. I think what's wrong, it's not so much that I think the alignments are wrong. In other words, shareholders take a long view or a longer term view, and yet a lot of the rewards are paid on an annual basis. And there's no ratchet back. So I think you really have to have an alignment of interest so that rewards, if there's going to be this reward and an incentive system, it has to be over a longer period of time. If I give you money and I give you the money for 3 years or 5 years, how did you do at the end of the 5 years? As opposed to each year the executive gets paid on how we did, but in the end, I made no money, but he's walked away. So I think it's really more an alignment of interest and an alignment of interest with the shareholders that really is much more important.
Thank you. There was somebody, near the back there, and then I'll come to you. Man with his left hand up. That's it.
Hi, John Gee from the Bank of England. Clearly, as Jean-Claude said, we're going to tighten up regulation in all sorts of ways in the coming years. But one growing strand of thought at this meeting is that we need to do something much more radical to the core of the banking industry and turn, if you like, create a regulated utility at the center of our financial system. And I wondered if anyone on the panel thought there were any attractions in that, and secondly, whether they like it or not, do they think it's going to happen?
Walter had a go at that, a sort of version of that question right at the start. So perhaps I'd ask Marcus, what do you think about this idea?
The idea of banking being reduced to a regulated utility, I don't find attractive at all. I think one of the things that bankers need to continue to do is to recognize that they operate in a risk industry. I mean, it's put like that, it sounds unattractive, but bankers know that not every loan they make will be repaid. And their skill is in assessing those risks and pricing them correctly. And we can debate whether the pricing of risk has been done properly in recent years. I suspect it hasn't. I know it hasn't. But the fact is that by using the interpretation of risk properly, by being inventive, by being creative, bankers do help create wealth in the wider economy. And I think that to suppress creativity would be a mistake. And that may sound like a license for recklessness. I don't mean that at all. I mean good creativity, good inventiveness, good risk-taking is what banking has always been about and should always be about.
Jean-Claude, are you interested in narrow banking? You run a narrow central bank, of course, but...
I would say that we are experiencing extraordinary circumstances. I think what we should have in mind would be not to consider that what we will do today, because we are bound to do that in these exceptional circumstances, would be a permanent feature of global finance and of our economies. And so I think that we must have the exit strategy in mind. I don't trust really that, again, this idea that we could have permanent utilities, as Sir John said, would be really a feature for the future. I think we are de facto embarking, because there are very good reasons in some aspects that look like what you said, but I think, again, it is not and should not be a permanent feature. But what remains true is that the system is much more fragile than we suspected, and we have to introduce in the system, not in my opinion, utilities everywhere, but certainly cushions, buffers, amortizers to avoid, and I would say airbag in case of shocks. And it's true that what we've been doing over the last, say, 10, 15 years was, in a way, for very good reasons, but proved extremely dangerous, to diminish the buffers, diminish the cushions, combat the hidden reserves, for instance, that the banks might have had in Switzerland or everywhere else. And it was systematic. And we did not perceive, it seems to me, that we were making the full system more fragile. So we have to take all the consequences of that, and that we said that already, of course.
Thank you. Second row here.
I'm Don Donahue from Depository Trust Company in the States. Another theme that was coming through some of the panel sessions yesterday was, in the spirit of never wasting a good crisis, we can hope that the regulatory response to the crisis would lead us in the direction of much more globally coordinated, much more globally consistent regulatory standards across all financial institutions. But it seems equally likely that individual regulators are going to regulate their own individual spaces as they see the issues that need to be addressed, which could lead us in the direction of much more fragmentation in regulatory standards. Do members of the panel have suggestions as to how people in financial services should be working in the dialogue to really push this in the direction of global consistency in standards as opposed to greater fragmentation?
How does it look to you, Walter? Because I think it's a very important point, if I may say so, and there is a tendency for regulators and governments to say, look, we're going to support you, we want you to keep your money at home, but of course a global institution like Credit Suisse, that's rather difficult. What is home? How does it look?
Yeah, it's not only that we are a global institution. I think nobody really in his right mind wants to unwind the global interconnection of business. And by the way, given the information technology and everything, it's not possible. So the globalization of the economy is here. And to use Jean-Claude's image of the airbag, the risk is really big if you are in a car and just in the front area somewhere a small airbag gets out, and then another one. And it's not really clear whether that the airbags are coordinated in any way. Then it makes the system not particularly more stable. There is an idea at the International Institute of Finance to say we should have an international treaty regulating, in particular, or committing governments for the fact how to organize a global rescue for financial institutions, how to commit governments to adhere to regulatory standards, how to control that they actually adhere to it, and so on and so on. But institutionalized on a much higher level, on an international treaty like we do with other very important coordinations in politics or whatever you have. And that would then lead to some sort of formalized council to coordinate global regulation, supervision, and rescue in these kind of situations. I know this is a very long shot, but it at least opens the debate whether we need an institutional framework to do that, which is much more much stronger than what we have now with these kind of mutual promises to do something when in case of need, and then the political situation in each individual country in case of need becomes so internally focused that there is a completely different mood. So that is an element of debate which an element which the IIF Committee on Efficient Regulation is probably tried to bring into the debate.
Thank you. Woman here with the red top, and this may have to be the last one.
Thank you. Sharon Burrow, representing the global labour movement. I want to just ask your perspective on two pieces. One is, in fact, multilateral institutions. It seems to me that in discussions we've had with the IMF and the World Bank, but particularly the IMF, that they claim they were actually issuing warnings. They claim they were advising that there was enormous fragility in the system, but nobody was listening. If that's the case, then you've got to look at the reform of the IMF, which is part of course, the G20 agenda. But what is the role for multilateral institutions? Do we need a new Bretton Woods deal? Is the structure compromised by governments sitting on a board who simply don't want, bad news around their own interests aired at the expense of all of us? So what do you see as the role for new investment in multilateralism? What's the global governance framework? And I must say I'm interested in how that would play out in terms of the treaty idea. The second thing is simply, how do you rebuild trust? I mean, in all honesty, I just sat here listening to someone say, no, we have to pay a fair wage and we have to do this. The innovation that you talk about, the creativity, was actually about the boom psychology that leveraged profit off debt and believed it was sustainable. The victims are our members. They're working people who are losing their jobs and their homes every day. And yet, when they look at, the Wall Street press just last week saying, oh, it's such a shock that, that bonuses are down by X%, and they're still multi-million dollars, you're not going to rebuild trust in your own backyard with the people who actually make the wealth of the globe, unless it's more equitably shared, unless, frankly, the conditions around smart regulation, not just regulation for regulation's sake, we're not interested in that, but smart regulation that gives people back confidence that they're not simply going to be part of a casino capital market they have nothing to do with in the future.
Thank you. Jean-Claude, I think I'm going to have to give you the last word on the multilateral dimension. And then maybe I'm going to ask Henry for 30 seconds on rebuilding trust.
Thank you. I think, of course, it was a very, very important question. I really trust, as I said already, that multilateral institutions are of the essence for the functioning of global finance and the global economy. I make the difference between the informal groupings like the FSF, like the G20 or the G7, G8, and so forth. These are informal groupings where you mature possible consensus, you work, but then it has to be implemented, and it is implemented in a large number of institutions, including the IMF and the World Bank. But the question remains, if we all agree on a very efficient surveillance of the macro policies, for instance, through the IMF, and the World Bank has also a very important role to play, then will the shareholders of the IMF give the political backing which is necessary when you have tough remarks to make and tough recommendations to make? And this calls for, in a way, a paradigm change at the level of the international community as a whole. I think that there is an emerging consensus to go along this line, but of course it calls for a lot of energy and a lot of, I would say, political energy.
Thank you. Henry?
The question is a very appropriate question, and it's something that I've thought a lot about, and that is where has the financial institutions gone wrong as far as trust? Number one is lack of transparency. Two is short-termism, and I think that's a big issue. And number three, they've really focused on one thing for the most part, and private equity is included in this, absolutely, is they focus too much on profits as opposed to all stakeholders. And I will say, for one, that we at our firm are focusing a lot and have been probably for the last 4 or 5 years now on stakeholders, and that includes NGOs, it includes employees and customers, suppliers, communities, the environment, et cetera. And so I think a very big part of where the financial institutions have gone wrong is lack of transparency, a focus on profit, and that's about it, and short-termism. And I see all of that changing very dramatically going forward, and I think part of it will be tied back to something that the panel has talked about, and that is an alignment of interest with the shareholders and all stakeholders.
Thank you. I'm afraid we are now out of time, slightly beyond it. I'd like to thank the panel on your behalf. We had a lot of talk about airbags, but we had absolutely no windbags on the panel. Very succinct answers to questions, and thanks them for some very good questions as well. Thank you.